Welcome back to the channel, Wealth Tubers. Today, we're diving into one of the most talked about questions in the housing market right now. Is the housing market going to crash? With skyrocketing prices, rising mortgage rates, and an uncertain economic landscape, many are wondering if a major downturn is just around the corner. But what do the experts have to say about it? Is the market headed for a sharp drop, or are these concerns overblown? We'll take a closer look at the latest insights, breaking down key data, economic trends, and expert opinions to help you understand what's really happening. Whether you're a first-time homebuyer, a seasoned investor, or simply curious about the future of the market, this video will give you the information you need to navigate these uncertain times. Stick around as we dive deep into the potential risks, opportunities, and what the next few years might hold for housing. Let's get started. To the dismay of would-be homebuyers, property prices just keep rising. It seems nothing, not even some of the highest mortgage rates of the past 2 decades, can stop the continued climb of home prices. Are they destined for a fall? Here's what the experts say about a potential housing market crash.
Home prices rise ever higher.
A starter home now costs more than $400,000.
West Sonica Donge looks at what that dollar amount can buy you in different Central Florida neighborhoods.
The numbers speak for themselves. According to the Zillow Home Value Index, 10 years ago, the average Florida home was valued at $144,464. Today, the median home price is $420,000.
The U.S. housing market had finally started slowing in late 2022, and home prices seemed poised for a correction. But a strange thing happened on the way to the housing market crash. Home values started rising again. So much for the now quaint notion that the post-pandemic housing recession would reverse some of the outsized price gains in homes. In another reflection of ongoing increases, the S&P CoreLogic Case-Shiller Home Price Index for August was up 4.2% from a year earlier, another all-time high. Despite prices being high, though, the volume of home sales has plunged, and inventories are still too low to meet demand. Homeowners who locked in 3% mortgage rates several years ago are declining to sell, and who can blame them, with current rates more than double that? So the supply of homes for sale is staying tight. As a result, any correction will be nothing like the utter collapse of property prices during the Great Recession, when some housing markets experienced a 50% cratering of values. Even with the rapid price appreciation over the last few years, the likelihood of a market crash is minimal, stated a November 2024 report. Distressed property sales and the number of people defaulting on mortgage payments are both at historic lows.
The election's impact on the housing market.
And election years can have big impacts on our economy.
Yeah, good morning to you. So home sales can dip as much as 15% in November when there's an election compared to non-election years. That's according to a study by Myers Research. And that research includes the last 13 election year cycles prior to 2023.
In addition to high prices sticking around, the new consensus among economists is that the results of the presidential election will lead to higher mortgage rates. President-elect Donald Trump has promised tax cuts, and the U.S. Senate, soon to be controlled by Republicans, is likely to go along. As a result, the federal deficit is likely to grow quite significantly. To pay interest on the mounting federal debt, the government has to issue more Treasury bonds, says the chief economist at Market Insights Group. Investors have already driven yields on Treasury bonds up as of November 6th, demanding a higher return with the expectation of higher deficits. Mortgage rates will closely follow yields on the 10-year Treasury bonds and will likely increase in the weeks ahead. Trump's proposals thus far regarding housing affordability could have a mix of good and bad consequences. The supply-side policies proposed by President-elect Trump are likely to help increase supply, but demand-focused proposals could have unintended negative consequences. A key feature of the Republican Party platform is the pledge to stop illegal immigration. The goal would be to curtail housing demand, and thus the cost of housing. But reducing immigration could severely hurt the labor supply needed for new home building. About 31% of construction trade laborers are immigrants. According to data from the National Association of Home Builders, that's a record high.
Supply and demand.
The main driver of record home prices is a one-two punch straight. a lack of housing supply coupled with strong demand. Inventories have been growing but remain frustratingly tight, with NAR's September data showing a 4.3-month supply. Not even high mortgage rates have slowed price appreciation. For instance, in October 2023, home values held steady even as mortgage rates soared to 8%, their highest level in more than 23 years. They have since dipped, but not enough to make a meaningful difference, despite the Fed's rate cuts. The average rate for a 30-year fixed mortgage in Bankrate's weekly survey, released November 6th, was 7%. You're not going to see house prices decline. There's just not enough inventory. We're not in that space where things are suddenly going to be more affordable.
Is the housing market going to crash?
No. Housing economists and analysts agree that any market correction is likely to be modest. No one expects price drops on the scale of the declines experienced during the Great Recession. There are still far more buyers than sellers, and that means a meaningful price decline can't happen. There's just generally not enough supply. There are more people than housing inventory. The sharp rise in mortgage rates skewed the market. Many would-be buyers had been waiting for rates to drop, but if rates decline significantly, it could send a rush of new buyers flooding into the market, pushing up home prices. You've got an entire generation of pent-up demand. We're in this fascinating position of tremendous demand and too little inventory. When interest rates do come down, it'll be another boom and bust cycle. The numbers don't represent a crash, but they do show a housing market coming back to earth.
5 reasons there will be no housing market crash.
Housing economists agree that even if prices do fall, the decline will not be as severe as the one experienced during the Great Recession. One obvious difference between now and then is that homeowners' personal balance sheets are much stronger today than they were 15 years ago. The typical homeowner with a mortgage has stellar credit, a ton of home equity, and a fixed-rate mortgage locked in at a rate much lower than today's figures. The experts point to 5 compelling reasons that no crash is imminent. First, inventories are still too low. A balanced market typically has a 5 or 6-month supply of housing inventory. NAR says there was a 4.3-month supply of homes for sale in September, actually quite a big improvement. Back in early 2022, that figure was a tiny 1.7 months. This ongoing lack of inventory explains why many buyers still have little choice but to bid up prices. And it also indicates that the supply and demand equation simply won't allow a price crash in the near future. Second, builders aren't building quickly enough to meet demand. Home builders pulled way back after the last crash, and they never fully ramped back up. Now, there's no way for them to buy land and win regulatory approvals quickly enough to quench demand. So a repeat of the overbuilding of 15 years ago looks unlikely. The fundamental reason for the run-up in price is heightened demand and a lack of supply. As builders bring more available homes to market and more homeowners decide to sell, supply and demand can come back into balance. It won't happen overnight. Third, demographic trends are creating new buyers. There's strong demand for homes on many fronts. Many Americans who already owned homes decided during the pandemic that they needed bigger places, especially with the rise of remote working. Millennials are a huge group and in their prime buying years, and Hispanics are a growing demographic also keen on homeownership. Fourth, lending standards remain strict. Back in 2007, liar loans, in which borrowers didn't need to document their income, were common. Lenders offered mortgages to just about anyone, regardless of credit history. Today, lenders impose much tougher standards, and successful borrowers have excellent credit. The median credit score for new mortgage borrowers in the second quarter of 2024 was an impressive 772, the Federal Reserve Bank of New York says. If lending standards loosen and we go back to the wild, if we start to see prices being bid up by the artificial buying power of loose lending standards, that's when we worry about a crash. And lastly, foreclosure activity is muted. In the years after the housing crash, millions of foreclosures flooded the housing market, depressing prices. That's not the case now. Most homeowners have a comfortable equity cushion in their homes. Lenders weren't filing default notices during the height of the pandemic, pushing foreclosures to record lows in 2020. And while there has been an uptick in foreclosures since then, it's nothing like it was. All of that adds up to a consensus. Yes, home prices are pushing the bounds of affordability. But no, this boom shouldn't end in bust. Thanks for tuning in, Wealth Tubers. If you found this video insightful and want to stay ahead of the curve on the housing market, I want to hear from you. What do you think the future holds for the housing market? Drop your thoughts in the comments below. And hey, don't forget to subscribe and hit that notification bell. Thanks for watching, and I'll catch you in the next video.